Right. Hello, hello. Just want a mic test. Mic test, mic. Okay. All right. So today we're getting into maybe the most important day of the camp because this is exactly how we take trades, what we take it off of, why we take the trades, how to exit, how to enter. This is the most universal trade topic we probably take, honestly. And it's going to be liquidity. Now, the reason this is the most universal is, well, most universal we know because first off, it's in every single time frame, and every time you want to enter a trade, you're gonna need to use it. Every time you want to exit a trade, you're gonna need to use it. Now, liquidity pretty much is if you have here, let me just draw it out, right? Hold on. Right? If you have these candles where it's like this, and this is just a random example, right? You got these highs up here, and you got these lows down here. Now, this means if this ever gets ran, like if a low ever gets hit that has equal lows, let's say, or just lows in general, us smart money concept traders say that the sell side liquidity has been taken down here because retail traders usually have their stops underneath old lows and old highs. So the market likes to target those old lows and old highs, right? So let me find some examples of what I mean right here. Perfect. And this is a 4 hour time frame. You're moving up, you're moving up. Now, retail trader, they probably enter in around here when the market structure shift happens and they're bearish. So they probably want to get all of this down move. They think it's going to retrace down to here, right? So they put their stops where? Where do they put their stops? Right above here, right? So now mm, there's pretty much liquidity that the market generates when these retail traders, many of them, because the market's a multi billion dollar market, many of them have orders, stop orders, sell limit orders above this old high, right? And this is a very good area of liquidity to be target. Even though this is hindsight, we know it's going to go up and go through it here. We knew that was going to happen. But the reason we even knew it even more is because this was a failed swing high. It never came up. If this came up and swung it, hit it, and then moved lower, then okay. But it never did that. It came up just before, never swept this high, and then moved lower. So that means that there's definitely low resistance liquidity above these highs. Very important because this is what most of our trades are really taken off of. That you want to find a position up to these highs to go long. Obviously, because first off, what did we say what the trend was, right? We said it was bullish. Other than so when you're after you're done sweeping all-time highs, I think we swept it like maybe down here or something, right? So these were the all-time highs, but before that there was no liquidity before. I don't know where we swept it. Let me see. Oh, I called it perfectly. We swept it right down here, right? So that was our only buy side liquidity. After that got taken, then the market will be generating liquidity. I know this is very hard to understand because I'm just not explaining it too great. But what I'm trying to say is that these old lows and old highs are very important because they're going to get ran through. For example, right here, boom, these two are relatively equal lows. You mark these out in time, they're going to come back for before moving up because right even though you see this what did I say? You come up, Sometimes the market likes to retrace for more liquidity or some imbalance and then move higher up, right? And that's exactly what happened. It came up, retraced, took out these sell orders. So this is where retailer, right? So they see the breakout, right? Because retailers trade off these old highs being broken, right? So they see that, they see these old highs getting broken. Now they're like, let me get in long. So they get in long, where they're probably, I don't know, somewhere up here, and they put them underneath the old lows, for example. Oh, nice. So we're getting this break market structure shift. Let's put our stop underneath this old low, and then let's target higher, right? So the market relates back to those areas, comes back, stops them out, and then goes higher. And what does it do? Any retailers that want to go short, these are equal lows. I mean, equal highs. So these equal highs are very high confluence of being hit because, first off, they're both equal. So that means there's more residing liquidity above it, right? So you see here, this is where the buy limits are. Where if you're going short, if retailers thought, oh, now we could go short, let's put our stop, boom, above these highs. Which obviously they get shit on. But this works everywhere. So old highs and old lows. Always remember that. Right here, 4-hour candle. What is that? An old low. Usually after, if the market wants to move up, and you could take notes on this, if the market wants to move up, it's going to sweep a form of sell side liquidity and then move up. Or if the market wants to move lower, it's going to sweep a form of buy side liquidity, right? And then move lower into the sell side, back up to the buy side liquidity, chops around. This is the accumulation, right? As you can see, all this choppiness is accumulating. For what? Longs. Anyway, let me just say one thing. When you're trading, and I know this doesn't really have much to do with liquidity and old highs and old lows, but this is extremely crucial. When you are trading, make sure, sorry, when you are trading, make sure you're not doing it for the money. Stop thinking about the money. Because in this market, if you make a $10 move off a run like this, you can make $100,000 move off of a run like this. It's all fractal. All that matters is predicting where price goes. So stop looking at when you're in a position and it's going up. Don't look at how much profit you're gaining or how much you're losing. Look at the percentage. If you could get a 3% trade of your account, a 5% trade on your account, you will be a millionaire in the market guaranteed. Okay. Anyway, so now that we're learning about liquidity, even though we're in a bull run, this is a perfect example how it generates. So after, as I said, it swept all-time highs over here. Now, you see these long price runs for days, right? These are all 4-hour candles, so this is days of action. Now, why does it do this? Because the market, this whole range, now has no more liquidity, but it's still bull, right? We know that. So right now it's accumulating. So as I said, it's accumulating, but what is it doing? Setting up new forms of buy side up here, and sell side liquidity. And technically what this means, so as you can see, it moves up, and ignore all of this, right? It moves up. This is news, so it crashes down, sweeps out. What does it do? It sweeps out this old residing buy side liquidity, and now we can couple the things we learned together into a fair value gap, right? So it comes, sweeps liquidity, taps into the fair value gap. What does it do? Now you could target the next buy side. And this is how you would go about entering a trade, right? So what can you do? Buy side liquidity. go up. You could find an entry on the 1 hour maybe, or a 15-minute or whatever. You wait for a break of structure. Boom, break structure here. You could wait for a lower time frame fair value gap to happen. Taps into this fair value gap right here. Let's see on the 15-minute. Let's see if it gives us an even smaller entry. And this is how I would go about entering. So you get this wick, get a break of structure. You could have entered in right here if you wanted to. I mean, this is just very easy. You could have went even lower on the time frames. Let me see. I don't know if it'll let us go that far back, but all right. It's not letting us go that far back. So, but that's just how you see. So take notes on this. This is the most important part right here. When you have highs and lows and highs and lows like this, right? For example, this is an old residing high. So you would mark that out, right? There is buy side liquidity. Here's some buy side. And now that it's swept out this buy side liquidity, it never swept out these equal lows. So what can you, it's common sense. I mean, what can you anticipate happening? There's equal lows that were never swept. Now, if this swept this and then went up, then it doesn't have to come back down. But since these were equal, that means that there's resting sell side liquidity. And so you can anticipate the market coming back down after sweeping buy side, breaking, right? You don't want to enter in off this leg, like I said. It'll probably come back up until like an imbalance, break structure, and you can enter in off the break of structure or wait for like a smaller fair value gap or something. And it will eventually come back and hit that level, right? And you see it every day in the market, literally every day. For example, today. Today I took a trade and it was a successful trade. And right here, boom, market open, 9:30. Let me find it. Where's the vertical ray? Right here. Right? So market opened right here at 9:30. I had this 15-minute imbalance that it was playing inside of. And we had, I believe, I had this. Can't remember exactly what. I know I had this low marked out for sure. Anyway, let's just play with that one. We had that low marked out. We had this fair value gap, and we didn't need a sweep because it swept it in the pre-market. It swept out some liquidity right here. You had this fair value gap. I was looking for this. I consider that as an hourly sweep, but there was a 15-minute liquidity sweep right here from this old high. And then this created equal highs. So what do you see? It comes back up by the end of the day. It came down, bounced down to this. What is this? Sell side liquidity, and went back up to what? Buy side liquidity. It's very simple. I'm just trying to keep it simple. Sometimes I get ahead of myself. But the price of the market literally just bounces around this, right? And we can anticipate eventually these highs getting touched if we remain in the bull market because these haven't been swept. This high never swept this high, right? So these highs are very good highs to target. These two are equal highs. Target these. These are very good highs to target. But as you could see, and this was a higher time frame move, so we had this 1 hour sweep. Even though it went up, we knew that this was a sweep. You didn't have to enter in up here because you didn't know. What if that was just a break of structure and it continued, right? And bounce up this fair value gap. But once you saw a break structure to the downside right here, you knew what we were looking for. We were looking for shorts. And what did we do? Oh, additionally, this was the other point. These two equal 1 hour lows. So you see how when they were equal, they have a higher chance of being touched. Tapped right in. And I'm sure on the 1 minute you could find some crazy entry. Right? So tapped in, swept out this sell side. And I believe this was a 5 minute entry because I was also looking for the reversal right here. Boom, fair value gap. You could have looked for this to be closed above. Inversion right here. You put your stop underneath the low or underneath the candle's low. Target old low resistance liquidity. Like, because one of my friends asked me, how do you know when to exit a trade? So if I was taking this long trade based off of what I've learned, I would have hopped in here right off this close. Either stop underneath the low that already swept liquidity. You could put it all the way down here, but I like having a better risk to reward. And then what do you target? Old highs, because these are old levels of liquidity. That's how I exit my trades. I go about targeting all of these old highs. 1, take profit. 2, take profit. 3, take profit. And as this is going, you can scale your sell loss. So as it gets higher, your stop loss shouldn't be all the way down here still. Like if it hits this high, your stop loss should be like at least above break even or at break even, right? So until it hits that high, I would have had it at break even. And then boom, another, and that would have been a fire trade, right? Would have ended up being at least a 1 to 3 until it swept out this buy side liquidity. And that's just the hardest part is, first off, if you just go in the chart and mark off like noticeable highs and lows, they're gonna get hit eventually, far enough in time. Like, let's find some noticeable highs and lows, right? Before this whole price run, we had this one that was a noticeable high and low. High, noticeable high, right? Noticeable high. Let's mark out some noticeable lows. Noticeable low, what does that do? Just sweeps it and leaves it. You could go in the daily to do this actually as well. See, right now, this could be a setup. When it leaves lows like this that hasn't gotten touched, it will eventually come back for it. So this could be a setup for, shorting. But down here, what do you get? You get this sweep of the low, and then price taps it. Doji candle, right? We talked about that on the first day. Doji candle, because this is literally indecisiveness. Reverses. You could couple that with the fair value gap. It comes into it. You could enter in here and target what? Buy side liquidity. So that would have been an easy swing trade, honestly, up to these highs. Stop underneath this. That would have been a 1-2 swing trade. Anyway, if you have any questions, leave it in the comments. I hope you guys learned well from this. I'm not the best teacher, but I'm trying. Have a good day.